Okay, we've got a fun surprise for you here. We're going to show you now how to use the case study calculator, which we developed after looking at all the really complicated software that's out there right now. And so, you know what? How do you use this as a learning tool where you can quickly and easily crunch out a case study for cash flow and rate of return and cap rate? But more importantly, how do you then look out into the future? So if you click right here on this graphic, it'll bring you to our case study calculator. The first time you log on, you're going to have to say that you agree to the terms of service, which includes a big disclaimer that says that nothing that you see here is guaranteed, that as an investor, you're putting your money at risk, etc. But let me show you how to use it. So you go to the purchase price. I'll put in $250,000. And I'm going to put a down payment of $75,000 and closing costs of $12,000. Now you're seeing that my charts are beginning to populate. There are three charts here: investor equity, cash flow, and rate of return. And as I start entering these pieces of information in, here's a 6% mortgage rate, you're seeing things begin to fill out. The first one, the investor equity, shows you that if the property didn't appreciate over time, I would build, let's say over 10 years time, I'd build my $75,000 plus $12,000 in closing costs would be $106,000. But what if I saw a 2% annual appreciation? If I bought at the right time, if I bought in the right place, and if I bought a property that had upside, what would happen then? Well, there's my investor equity over the next 10 years, shows me $167,000 in equity. So again, we want you thinking long term here, and so we project out 30 years into the future until that baby is basically all paid off. Next, if we scroll down, it asks us for the basics of cash flow analysis. So I'm going to put $18,000 a year in annual rent. I'm going to put a vacancy rate. And by the way, if any of these things are foreign concepts to you, go ahead and register for the full class. That's what it's here for. So we're giving you a sneak peek into the kind of tools that you can have access to right now. But if you really want to learn how to apply these with strategy, with planning, with some really deep analysis, that's what the class is for. But here under operating expenses, I'm going to throw in $6,000 in taxes, $1,000 in insurance, and I'm just going to put in another miscellaneous $1,000. Again, I'm being quick here. You're going to want to be accurate. And so what it shows me is, I've got negative cash flow here. Lousy investment, right? Maybe, but let's keep going here because I've got a rate of return calculation down below, which is beautiful because it bundles together everything. The internal rate of return takes how much money you put in down payment and closing costs, how much money you took out in terms of cash flow or put in terms of negative cash flow, and gives you that number. The kind of number that you're accustomed to getting when you have an investment account or a bank account, the rate of return. Here it shows you that even with all those losses, I still have a positive rate of return because I do have an appreciation rate and my property is amortizing. But here, I'm going to want to project into the future what my annual rent increases might be. Now, we're big advocates of putting automatic rent increases in your leases. So if you were able to get 3% increases in rent and 1% increases in expenses, meaning you held your expenses down, this now shows that while you're losing money in the beginning, by 2018, it breaks even and it begins to make money into the future. Your equity didn't change because equity is a factor of what the property's worth minus the mortgage balance, but the rate of return changed and it goes north of 5% now. But here's where this gets really exciting. Now you're looking at a baseline analysis of a property. What we teach in our courses is how to find markets that are distressed right now and have upside, how to find properties that are distressed in those markets and create upside in those properties. So let's say instead of 2% annual appreciation, you managed to do the annual national average of just 3.4% on average. Watch what happens to all my charts now. Now my equity jumps. So over the next 10 years, I've got $217,000. My cash flow didn't change because that's a factor of what my rent is minus my expenses, but my internal rate of return is now approaching 8% and going north of 8% as the years go by. And then of course, if I change my rental income, let's say instead of getting $18,000 a year in rent, I start off getting $19,000. Now what happens? Now my break even happens earlier and my internal rate of return is now north of 8%. By using a tool like this, you get to take all the moving parts of a real estate investment, what you pay, what your mortgage rate is, how fast you pay it down, what your appreciation rate is, what your rent is, what your vacancy rate is, what your expense and rent increases are, and boil them all down into a visual, graphically pleasing display, and then all boil it down to what my rate of return number is. Now, these are savable as a PDF. They're shareable in your social media, and you can even compare two scenarios side by side to watch the way the different assumptions work. Hope you enjoyed the case study calculator. Post a comment, contact us, take our courses, and let's go make a lot of money together.